If this chart looks confusing to you, don't worry, okay? If this looks overwhelming, it's not a problem. We're going to break this down and we're going to analyze this chart, which is Bitcoin against US dollar. Now, as you can see, I've selected Binance, and the time of this goes back to middle of December 2020 until the present day, which is currently the end of May 2021. So this is just a blank chart with nothing on it apart from the price action, okay? And as you can see, we started to climb, reached a peak on the 14th of April, and then have been in a downward momentum since, okay, for various reasons. When I'm analyzing prices, I don't really think about the fundamentals. I purely look at the price and purely look at the chart to tell me what is going on. I try and deduce from the chart what the price is likely to do. I don't really think about the fundamental changes. I don't think about the media or the news. I'm literally just asking the chart or looking at the chart and looking at what it can tell me about what the price is likely to do. Okay, so principally we use candles in order to tell us what price movement is happening. Okay, so if we look at this particular candle here, this is a very bullish candle, and I'm looking at this on a day chart. Okay, we started the day, so at midnight, 0000 UTC. We started at around $39,000. By the following midnight, we had ended up almost $10,000 higher at $46,500. Okay, with not much variability in between. Okay, that's a nice candle there with a big green body, which means that the entire day was basically bullish. Okay, now if we contrast that with another one, this down day here, okay, we started the day, we opened the candle, okay, 0000 midnight at 37,800, and we dropped all the way down to 30,500 or so. Okay, but then we bounced back up to actually finish at midnight around about 35.2. Okay, so at some point you could have bought Bitcoin for 30,000, and the very same day you could have sold it for 35.3. Okay, this is what these wicks tell us. These wicks just tell us where the price has likely been, okay, or where it has been during the day, and it could have been there at any point. Okay, this could have been a flash down to 30,000 and then a quick recovery, or it could have been down there for at least a couple of hours and then made the recovery. The important thing is that each of these candles covers a 24-hour window, and the body is where the price ultimately finished. The wicks are where the price was at some point. And look, the body can be tiny. This is what's known as a doji in the advanced technical analysis and charting terminology. It's where the price had a very, very small body and there was a lot of indecision, but there was quite a lot of variability of the price over that 24-hour period. Okay. Now, if we look on an hour chart, we go down to an hour, we'll actually see this is even more volatile, because obviously we're viewing it over a smaller time frame, and volatility is affected by the time frame that you're viewing it on. So there are some here where we have movements, extreme movement over the course of an hour. Here we go. Okay, so in this chart here on the 19th of May, we were at 38,000 at midday, and by 1 o'clock we were down at 28,000, but then we had a quick recovery. Okay, the volatility is everything. But then if you look a few hours later, 24 hours later, at 3 a.m., very little volatility here at all. Okay, so this is one of the things you're going to need to notice and learn is when the markets are volatile. Okay, and they're usually volatile at certain times of day. Usually those are the office hours around the world. So in London, obviously 9 till 1 is going to be fairly active, and then between 1 and 2 the US opens, because it's 9 a.m. in the US, and between the hours of 2 and 6 there's quite a lot of variability in the prices, just because both the European markets and the US markets are trading. And then in the evening, between the hours of 9 and probably 2 a.m, that's the Asian markets, so Hong Kong, China, etc., Japan, trading hours. Okay, so those are the 3 times, and you'll notice that there are dull moments in the markets and there are very active moments, and they are usually connected to those. With cryptocurrencies and it being a retail trader market, it's not as clear cut as something like foreign exchange. With foreign exchange, you pretty much can't trade outside of those times, but with crypto you can. And one of the things that is very different about foreign exchange and crypto is weekends. Weekends tend to be quite volatile because retail investors have more time on their hands than they might do during the week. Okay, so effectively what I'm saying is bear the timings in the back of your mind for when there may be increased volatility, but don't rely on it all the time. Okay, so for example, if it's 3 o'clock on a Tuesday afternoon and nothing's really happening, then you might think that retail traders aren't really doing anything and the US and London are not particularly interested in crypto that day. Okay, whereas if it's 9 a.m. and something big has just been announced in the UK in terms of news, then you can expect a large movement in cryptocurrencies fueled by volume from the UK. I mean, look at some of these volumes drop off completely between there. Okay, and that's on Binance. Okay, so there's hardly any volume in the market at that point. Okay, so just watch out for those, and obviously if you're trading, just be aware of what's going through the market at any particular period, and obviously think about the timing of your trades as well. Okay, excellent. So what I'm going to be doing in this video is just demonstrating why it's also important to focus on the exchange that you're trading on. Okay, this is 2 identical charts, but I'm using 2 different trading tools. Okay, I'm using 2 different avenues in order to get my price data. Let's move that back to a day. Okay, so if we go to a day charts and we zoom in, we've got this set of data here. Okay, now this set of data matches this set of data. Okay, it roughly goes back to the beginning of 2021. Okay, but what you notice here is that Binance, which has more volume, has fewer wicks and larger candles. Okay, whereas this other chart that I'm using, BitBay, okay, has a lot of wicks, okay, and also not very many candles. Okay, that's a general indication there's not a lot of volume going through the market, and if we look down here we can actually see the volume is minimal at times. Okay, this is not good for trading. Okay, if you see low volumes and you see wicks all over the place, not really a great market to trade unless you're really happy taking the risk. I mean, look at this. You could theoretically, in theory, now with wicks like this, it's always in theory, okay, because who knows what the price could have done and where it might have been trading. But on the 23rd of February, the price started at $51,000 for Bitcoin on BitBay, and at some point was actually down at 7,600. Okay. Now, whether or not the price was actually tradable down there is another story entirely. Okay, there might have been someone who sold 1/100th of a Bitcoin at 7,600 by accident, and that's why the price suddenly cascaded all the way down there. Okay, so it's not like you could have just signed up for a BitBay account and bought as many Bitcoin as you like for 7,600 and then sell them. There is an advanced trading strategy called arbitrage trading, which takes advantage of these. So for example, you'd buy Bitcoin on an exchange like this at a discount, okay, and then sell it on Binance or another exchange for a profit almost instantaneously. Okay, that is a very difficult procedure to do, and it takes a lot of skill in order to do it, and it usually requires quite fast trading tools. Okay, it's not a beginner trade strategy, it's actually quite an advanced trade strategy that takes a degree of programming in some cases. Okay, so just bear that in mind. This wick, on the other hand, looks a little bit more reliable. Okay, you could have bought Bitcoin down at 32,000 or so, okay, and sold it the same day $20,000 higher. Okay, theoretically that could have been possible, but again, you take the added risk of having minimal volume. Look at the volume on that. Okay, it's hardly anything. Okay, when combined with other activities. So just take everything with a pinch of salt if you start to see wicks and candles of this quality. On Binance, not a problem at all. We've got plenty of volume going through, plenty of healthy candle action going through there. Okay, so let's have a look at BTC in terms of a longer time frame. Okay, I'm going back now on a day chart all the way to November, which is where we had that breakout of the previous all-time high. Okay, so I'm now macro analyzing this. Okay, I'm using a day chart because I want to theoretically plot where it might be in a month, 2 months, 3 months, even 6 months time. Okay, you can't really do that on anything lower in time frame than a day chart. Okay, so I'm going to start drawing on this to interpret this, because right now it's not really telling me anything. All it's telling me is that Bitcoin is $38,700 and it's been higher and it's been lower. Okay, but I'm going to interpret this so that hopefully you can start to see how to make sense of these charts. So I'm going to start by looking for liquidity zones. Okay, these are frequent areas where traders like to place their trades. Okay, and I can see one instantaneously here. Effectively what you do is you track where the majority of buys and sells are by looking at the wicks and the bodies. Okay, now when you draw a trend line through this is not a trend line, this is a liquidity zone. You want to try and get as many of the wicks and bodies as possible. Okay, so that is fairly accurate there. Okay, this liquidity zone here has been traded multiple times on a daily basis. Back in January, it was actually an area of support, and then it bounced off. So it broke through, supported, and then we had a drop off and a retest, and then we broke higher. Okay, so this is quite a powerful liquidity zone, and we've just retested it recently. Okay, the thing about technical analysis and trading is that you need previous price action in order to do it. Okay, if I'd have been analyzing this, a month and a half ago, okay, I wouldn't have been able to know where that was. I would have had this liquidity zone here, theoretically, but we could have continued higher, okay? The thing about technical analysis, previous price action is vital, okay? So when we have sell-offs, that's actually really good because it enables us to actually track where the liquidity zones are, okay? Now we have another liquidity zone that I've just spotted here, okay? Now this presently is acting as resistance to us going higher, okay? So we are now in a trend channel, okay? We've ricocheted off the bottom. We're now staying near the top. And my instinct feeling is that we're going to see another low before we see it break higher, okay? That's my gut instinct here based on this information thus far, okay? Now, if we start drawing trend lines in, the picture gets a little bit clearer still, okay? With trend lines, you always want to work from the lowest most point of when a trend started, okay? So arguably that's going to be around here. I'm going to choose the moment where it broke out of the 20,000 and started to climb, okay? So I'm going to do that. Once again, you want to include as many of the bodies as you possibly can, okay? And line up as much as you possibly can. It doesn't really matter if it breaks a little bit and then moves back through, okay? That's what's known as a trend line test, okay? And that's what's known as a fake out, basically, where the trend line is broken and the price stays a little bit beyond the trend line for a little while and then breaks through it again, only to resume its original direction. Okay, so that's there. And then obviously we've got another trend line break here, interestingly bang on the trend line, where suddenly we actually broke and then didn't recover. Okay, so that's two scenarios in one. We've got the fake out here and we've got the actual trend line break here. Okay, now how would we have known that this is a trend line break and this isn't? Well, when you're actually trading, you don't, okay? All you could do is notice that this is a liquidity zone, okay, which we could test lower. Remember, liquidity zones aren't fixed prices, but they are zones, they are regions, okay? And that region could extend as low as 29,000, okay? And it could extend as high as 34,000. So that's a $6,000, $7,000 liquidity zone there. Similarly with this one, okay, it could extend as high as 42,000 or as low as 36,000. Okay, so we could still be in that liquidity zone at those prices. Okay, the thing that kind of gives it away a little bit is this trend line here. Okay, so in order to establish a trend line, we need 3 markers. Okay, we need 3 price points. Okay, the more price points you have, the more reliable the trend line is. Okay, but if you notice, we're actually coalescing with this. Okay, so what's happening is the price is ricocheting off the top here and then going down here. So by this point, if you'd started drawing a tentative trend line here with 2 peaks, okay, you could have extrapolated out and seen that this peak, if it were hit, is likely to be a resistance level, okay, is likely to have resistance to it and therefore likely to sell off. And if you had have sold there, it would have been the perfect place to exit, okay. Would have been a risky place to exit because theoretically this could have continued, but notice it's starting to slow. The ascent is actually starting to slow, and the peaks are becoming lower, if you like. Look at this, okay, so the peak here is really nice and big, okay. Then there's a sell-off, okay, moderate sell-off, and then there's another peak which is miles away from the previous one, okay. Then a sell-off, this one not so much, not so high, not so aggressive, and then a sell-off, and then again just a slightly higher peak in terms of price action, so 60,000 to around about 64,500 or so, okay, so only $4,000, whereas the previous peaks 58 and 42, so $16,000 and then $4,000 or so, okay, so they're getting smaller. This would have been a clear indication that the market is exhausted, basically, and then we had the collapse, okay. Forget about what fundamentally might have driven this for a moment, okay. Just looking at the price action, you could determine that it's more likely than not to actually sell off here rather than continue to climb, especially with this triangle formation that we have here, okay. So let's focus on what I think is actually going to happen now, okay? And I'm actually going to use an advanced trading skill to do that called Elliott Wave, okay? Now, Elliott Wave is a fairly controversial branch of technical analysis. It has quite a lot of subjectivity around it, okay? It's not really within the scope of this module itself. If you'd like to read about it and look it up, you can do. There will be at some point an advanced module on the crypto class membership for Elliott Wave, which will delve really in depth about it. But effectively, everything progresses in 5 waves, okay? And those 5 waves are always either bullish or bearish, okay? So if I can start here, this is wave 1, okay? Wave 2 is always corrective, so it's always in the opposite direction to wave 1, okay? And it's usually a lot shorter. Then there's a third wave, which is always the most powerful, okay, and that is itself comprised of 3 waves, okay. So we had 1, 2, 3, which is nice powerful 3 of 3, 4 and 5, okay. So that's the end of wave 3 with 5 waves. Then we had a complicated 4, which is exactly that, okay, with an ABC, okay, and then a wave 5 to finish off, and wave 5 is always higher than the tip of wave 3. Okay, so that kind of conforms to Elliott Wave exactly. So that is wave 1 of a macro count. Okay, then we've got 1 opposite direction. Okay, bearish. 1, 2, 3, again powerful. Okay, done in a very quick 1, 2, 3, 4, 5. Okay, then we got wave 4 of the macro count. Okay, which is this. And then at some point we will have a 5, which will probably extend down to maybe $27,000 to $25,000. Okay, where's that liquidity zone here? Okay, so there's a liquidity zone there. There's a liquidity zone here in this region. Okay, so between $27,500 and $25,000, maybe even as low as 23 to 22. Okay, maybe as low as that, but that will then be the finite movement that we can extrapolate on and take profit on. Following that, there will be a wave 3, in all likelihood, which will take us comfortably past the previous all-time high of 65,000. But that is a little bit out of the scope of this introductory module to technical analysis. But I hope now that the price action is starting to resemble a little bit more sense to you. And I hope that you've been able to see the support and resistance levels that I've drawn in with the liquidity zones. I am looking for any demonstrations that you're able to do of your own analysis. And obviously, remember, analysis is not an exact science. It is a hypothesis generating exercise. Okay, this could all change tomorrow. Okay, if suddenly we started to climb here and went out of this, then I'll have to reinterpret my previous interpretation of what was going on. Okay, it might be the fact that I've miscounted or that my interpretation is wrong. Maybe this is an A, B, C, and we're actually due another wave up here for a 5. Okay, and this count hasn't actually finished yet. Okay, again, there is a high level of subjectivity to technical analysis, and you have to be prepared to be wrong more than you are right. Okay, and the quicker you realize you're wrong, the better. Okay, if you're able to be humble like that and also not biased in any way, obviously I'm extremely bullish on crypto, but I don't want that to cloud my judgment. I'm very happy for prices to continue to fall as long as I'm out of the market and I have the ability to capitalize on it. Okay, I'm not overly bullish all the time just because I believe in crypto. I'm actually fairly rational when it comes to these, and I know that the volatility is always going to be there. I was telling people around about the 20th of early April, I did a talk on the 20th of April, for example, where I said it's likely that we would have a sell-off. Okay, that's the region where we were seeing these kind of prices, where everyone was very exuberant and euphoric about the prices of crypto at that point. And then suddenly we had the fear, uncertainty, and doubt kicking, and we're now trading a lot lower than that, and there are now people intimidated by crypto as opposed to euphoric about it. But as long as you keep rational and you keep, a good level of indication about what's going on. I've just spotted another liquidity zone here as well. Okay, so good if you spotted that as well. Fantastic. Okay, so this will be another resistance zone if we break out higher. Okay, so if we break here, maybe have a little test and then climb up here, $48,000 will be the next level of resistance where we actually stay probably fairly flat for a little while. Okay, then following that, the next liquidity zone is this region. So well done if you spotted that as well. Okay, and you can literally just look at this on any time frame and just look at liquidity zones. So the 4 liquidity zones that I'm keeping an eye on at the moment would be around about the $54,000 mark, the $48,000 mark, the $40,000 mark itself. Remember, these are $3,000 either side basically, and then the $32,000 mark, and then if we see it, the $22,000 mark. Okay. Naturally, the liquidity zones fluctuate according to the currency that you're trading. Okay, so there'll be pounds. If you're trading pounds, then there'll be different liquidity zones. Okay, and sometimes you can get more information out of looking into a cryptocurrency in a different currency than you're used to. Okay, so if you're looking at a liquidity zone and you want confirmation, perhaps look at it traded in euros, or look at it traded in pounds, or look at it traded in Japanese yen, for example. Okay, so pick markets which have quite high liquidity. Obviously, the US dollar is going to be the most active market, the most voluminous market. Okay, but look at other currencies as well to determine your technical analysis. The more you do, the more you corroborate, the stronger your hypothesis is likely to be.